Great. Thank you, Kelly, and thank you for joining me, everybody, and sharing your next hour with me. Again, my name is Cameron Jones, and I work for NFP. We are a national retirement plan, corporate benefits, and property casualty consulting firm. My role falls under the retirement division, and I'm specifically an RFP and benchmarking consultant, meaning pretty much all I do on a daily basis is ensure our clients' plans, whether it's through project engagement or ongoing engagement, are paying fair and reasonable fees. So we've done about 450 of these live bid benchmarkings that'll be walking through kind of what that process looks like. We've done about 450 over the last 3 years, myself about 100 of those. So we've seen just about every trick in the book, every type of fee structure, and we're very familiar with the market there. So with that, I'm going to go ahead and dive into the presentation on an advanced retirement plan benchmarking, talking about not just what is fair and reasonable, but what are some other soft cost providers might have that might be generating revenue from them, multiple revenue sources you'll hear me reference, as well as have a section on really how to structure plan fees. So diving in, why are we talking about this, right? So first of all, under ERISA and 408b2 regulations, 408b2 was an act that went into place in 2012 that made it where fiduciaries have to receive a fee disclosure from any service provider that they're paying for their services of $1,000 or more. So hopefully everybody's familiar and has their 408b2 disclosure from their providers. That is required by your providers to provide to you. Now what ERISA states is that you must determine if the compensation your provider is charging is reasonable. So it's not on the provider to charge reasonable fees. It's really on you, the plan sponsor, to determine as prudent stewards of your participants' assets that any fees being paid by your participant assets are fair and reasonable. So the beautiful thing about ERISA is that it's wonderfully vague. So it really all comes down to process that we follow to ensure this reasonableness of fees. So what specifically the wording is a fiduciary must act solely in the interest of the plan participants, their beneficiaries, and alternate payees to ensure that only reasonable expenses are being paid. Well, what is reasonable? Well, what's reasonable is going to be determined based on the process you follow to show reasonableness. So that process, according to ERISA, should be comprehensive, measurable, and documented with the care, skill, and prudence and diligence that a prudent person familiar with such matters would exercise. So keep in mind the prudent expert standard in ERISA is been quoted often as the highest standard in law. So the words "I don't know" are probably the worst things you could ever say if you ever go through a DOL audit or have a plaintiff's attorney kind of come towards your plan. The idea is that ignorance is not an excuse, and you are held to really the standard of an expert. So thank you for sharing your time today to hopefully brush up and learn some new concepts to bring back to your respective committees. Now, we talked about DOL audits are one source of liability, but plaintiff settlements have really focused on this area of fee reasonableness. Some key cases have been Tibble versus Edison. This actually made its way all the way to the Supreme Court. In this one, a fun, I shouldn't say fun, but where we saw that standard of the expert being established so high, this committee actually asked for an exception to get a lower cost share class, thus reducing the fee to pay their provider. And they were told no, they didn't meet the next share class that they asked for. And because they didn't offer a follow-up, request for exception because of their plan size and their length of relationship with the provider, they were expected to really ask for an exception to the stated, the first no that they got. So you're really held to a standard of not just asking once, but making sure you negotiate as much as your buying power of your plan allows you access to. So we'll talk about how to do that today. Tussey versus ABB. This was a lawsuit where the plan sponsors failed to monitor and control record-keeping fees. They actually got a report from their advisors stating they were overpaying for fees and still did not act on it. There was also some issues with the plan paying for corporate services, non-ERISA services, things like payroll services, and that's a big no-no from an ERISA perspective, so we'll talk about how to be careful with that. And then Danberg and Lemetries was another key case where there's a failure to minimize plan expenses. So really the plaintiffs' settlements attorneys out there, Schlichter Law Firm being the main one out of Kansas City, have really found a way to win these cases on fees. They started with large plans and have consistently moved down market. And they've also moved over to our neighbor plans from 401k plans to 403b plans. So 403b litigation has now started to focus as of 2016 on large university plans, Yale, NYU, Columbia, to name a couple. And the areas that the plaintiffs are focusing on are excess fund options, duplicative funds, retail versus institutional share class, and excessive fees and no RFP process. The challenge in the 403b world is a lot of these 403b plans are individual annuities. So the plan sponsors actually, if they remain in those individual annuities, don't have the ability to negotiate fees or change investments because the contract is not between the plan sponsor and the provider. It's between the participant and the provider. So what these lawsuits are focusing on is saying, well, by choosing to stay with individual annuities instead of moving to institutional contracts, a contract between the plan sponsor and the provider, that in and of itself is an action to stay where they are, and they're focusing on that inaction is still considered inaction from an ERISA perspective. The last reason why we should really be focusing on this is definitely fiduciary insurance coverage. Right, the insurance underwriters are even asking for proof of process prior to renewing their coverage to protect you as plan fiduciaries and ensure your liability. So we're seeing a lot of areas where this is of utmost importance to make sure you have a prudent process in place. So what we'll be focusing on today is first how to benchmark, the different types of benchmarking out there to show reasonableness of fees. Next we'll be looking at factors that impact pricing. This will be the bulk of our presentation. And hopefully it'll be a nice education for anybody who's newer to managing their plan or a refinement of what you might already be doing with your committees. And then lastly, how to maximize your negotiation leverage through this process. So first, how to benchmark. Meaningful benchmarking is really, you want to put the equal emphasis on cost and quality aspects. It does not say in ERISA that you must be with the lowest cost provider. You just must be paying reasonable fees based on the services you're acquiring. The main buckets of factors that impact fees are going to be your investments that you have in the plan and the services that your provider is currently offering. So we'll go through some case studies where we talk about how to actually quantify those numbers, but it's important not just to look at fees in a vacuum because they're really going to be dependent on the services that you're getting or what investments you have in there, right? A plan with all passive funds is going to have a different cost structure than a plan with all active funds. A plan receiving 100 days of education for their employees all over the country is probably going to have higher cost than a similar plan that isn't offering any education days from their provider to their employees across the country, right? So with benchmarking, you want to make sure you put equal aspects on what the quality is that's being delivered as well as the cost that comes with that. Now, when looking at providers, the services that we're looking at, you want to make sure those match with your demographics when going through a benchmarking process. So you want to look at their, the size and complexity of your plan, what service requirements your plan actually needs, and then the investment needs. And then the provider can actually deliver on it with, similar experience with plans of your size and type and complexity, their strength and experience with some of the service requirements you might have, and what system capabilities they have. Right? Some things you might want to keep in mind is if you have multiple payroll sites, that might be a challenge for a provider that's more turnkey and less customizable than a provider who has experience with very custom systems capabilities, right? How it integrates with your payroll system to ensure timeliness of deposits, right? These are all system capabilities aspects that you need to be aware of that impact how a provider is servicing your plan. So the two benchmarking approaches that are most common by fiduciaries are first, comparing your plan against fee averages. So these plan averages are derived from similar plan designs, similar plan features, and similar plan demographics. The alternative way to benchmark your plan is to look at provider requests for information, or RFPs, RFIs. You can use those really interchangeably. But this is derived from provider bids on your specific plan design, your specific plan features, and your specific plan demographics. So fee averages, what we've seen, don't necessarily generate the type of savings results for a plan if they were to also go through an RFI process, but still one way to show some sort of level of prudence. So Kelly, I think we want to open up the poll now. First, ask the question is, have you completed an RFI in the last 3 years? And your options that you can vote on are yes, no, or don't know. All right. Give it about 10 more seconds here. All right, so it's looking like we have about our final results here. Looking like now about 57% of folks have voted yes, 14% no, and 28% don't know. So a little color on this. This is, we'll dig into what this process actually looks like, but with the RFIs, nothing in ERISA says you have to do it every 3 years. There have been some DOL bulletins that said every 3 to 5 years makes sense for a live bid benchmarking of your plan. And the reason behind that 3 to 5 year mark is your plan demographics, what you're actually having providers quote on, changes over time, right? You might have more employees or less employees. You might have more assets that flow into the plan or more that are coming out. So 3 years is a long enough runway to give your plan some time to change where the underlying fact set and the assumptions the providers are going to be quoting on are going to be changing. So you want to make sure as your plan grows and usually becomes more attractive that at least once every 3 to 5 years you're benchmarking against live bids. Oftentimes that live bid might turn into also a consideration of finalist interviews, right? That you can bring other providers in to actually see what services are out in the market as the services in the market change over time. Every 3 to 5 years is probably a good window to see, well, what else is out there? Is my provider staying, ahead of the trend, or are there things that can better serve me and my participants? Now, fee averages, we're going to do another poll, Kelly, and the next question is have you compared your fees against averages in the last 3 years? Getting some votes in. Going to give it about 10 more seconds here. All right, I'll go ahead and read off the numbers here. Looks like we have about 42% have said yes, 42% have said no, and then about 14% have said they don't know. Fee averages, while not necessarily always as impactful as live bid benchmarking, is still best practice to do maybe in the years between that live, RFI, because if there's a big change in that 3-year period of your underlying demographics, let's say you've acquired another organization or you've hired 200 more people, when you go and compare now that, your new plan fact set against plans of similar plan design, similar plan features, and similar demographics, that averages is going to show if you've strayed way out of the norm, which might, frankly, have you do an RFI more frequently than that, waiting another 3 to 5 years to do it. It might generate you running through that process more soon. And so averages are a nice way to check on the years between the RFI. So both important, but we definitely know because the RFI is providers quoting on your unique plan and your unique fact set, it generates usually around a 25 to 40% difference in negotiation of your plan cost when going through this type of process. So important to know both. So the considerations your process is going to focus on is first, how much do the services cost that the providers are offering? Who's going to pay? So you can have, really, there's two people that can pay. You can have the employees pay, which is the norm in the industry, or you, the employer, can pay and write a check for it. An important thing to keep in mind is the Department of Labor does not care if you overpay for services as an employer. They really care if you are overpaying with your employees' fees that you're charging them. So your prudence is definitely focused on ensuring employee fees are fair and reasonable. But I think from a best practice, whether you're writing a check for all of it or having the employees cover it, it is still best practice to go through this benchmarking exercise. How are they going to pay? So we'll talk about the different ways employees can pay for it. They can pay for it through the revenue sharing and the funds. We'll explain what that is. They can pay for qualified services through a direct charge out of their account, or you, the employer, can write a check for it, or oftentimes you can use forfeiture accounts, non-vested accounts that are left there to pay for plan cost. And then, of course, what model is best for you? So our next section is really going to focus on those key areas. We're talking about the factors that impact pricing and how to go about doing this exercise so you know how to implement it with your plan to see which is right for you. So the main factors that impact pricing from a provider perspective. So when a provider is quoting on your specific plan, they're looking at some key areas to price it. The first is your plan financials. Think total assets in the plan. How many assets across each investment? How much money is going in? How much contributions you have, right? How much money is coming out from retired employees, people rolling their money out, etc. How many total active employees? How many terminated employees? Next is service requirements, right? Are they doing education for your employees? Are they outsourcing mailings? Are they outsourcing your administrative needs like tracking participant eligibility, doing enrollment solicitation on your behalf, right? How much are they actually doing for you, the service requirements? Next is going to be fund considerations. So a lot of providers in the industry have their own funds. If you have some of their providers' own proprietary funds in the lineup, they're going to generate more revenue. So depending on which lineup you use is going to depend on really what their quote ends up being, as they're now getting a second source of revenue. Plan complexity. Your plan design, right? If you have a custom plan document versus a prototype plan document, if you have multiple tiers of vesting schedules for different groups of employees, the more complex the plan design, the more that might drive up fees, as well as if you have to even use an outside party like a third-party administrator to run your plan design because it's too complicated for maybe the in-house provider standard document. Educational support, right? So helping employees, are they doing it in person? Are they doing it through the webinar? Is it automated, right? How you're delivering those services is going to impact how much that provider is quoting. And then compliance testing, right? Are you passing? Are you failing? That's going to impact the plan financials. So these are really the 6 key areas providers are looking at when deciding how to quote your plan. So it's important if you're going through a process to make sure they have all this information on what your expectations are for each one of these areas. Now, this next slide I think is the best visual representation of how fees can be paid, and this is going to address the concept of revenue sharing. So oftentimes when our clients have a new committee member who's learning fees, they might be hearing like your E-Trade commercials where they're talking about hidden plan fees. This is a big topic in the 401k world. Hidden plan fees are also known as revenue sharing, and this is basically just revenue to pay for plan fees baked into the stated expense ratio of a fund. So I'll show you what that looks like. There's components of the expense ratio. So if you think of this circle here as the stated expense ratio you see when you see a fund expense, as 1%, let's say, a portion of that's going to go to the investment management fee. So that's the portion of the expense ratio that's going to go to the actual fund company that's stating this expense ratio that's managing the fund. Might be, common names out there, Vanguard, PIMCO, Fidelity, American Funds, right? This is the actual fund company keeping the fund revenue to manage the fund. Now these next 3 components to the right are going to be different forms of revenue sharing. There's 12B1 fees, there's shareholder servicing fees, and sub-TA fees. Now, in the individual wealth management world, a lot of these fees are paid to the people distributing the funds. So think if you work with your own individual wealth advisor, they're going to get paid for introducing you to this fund by the fund company, right? So they're going to receive a 12B1 fee. Now, in the qualified plan world, in the 401k aspect, really the distribution of the fund is all really coming from the provider, right? It's all, you're getting access to this fund through your provider platform, whether that be MassMutual, Fidelity, Principal, you name it, it's coming through their chassis. So what the fund companies, they say, any revenue sharing, these 3 components to the right, included in our funds, you can use to offset your stated fee. So the way the providers look at this is they say, okay, how much revenue sharing, how many 12B1 shareholder servicing and sub-TA fees do each one of these funds generate, right? If that's enough for them, great. That's all they need to collect to pay for their fees. So 100% of their fees have been paid through the expense ratio. If that's not enough for them, they can add what's called a direct fee, which is also known as an asset or wrap fee. And this is just an additional fee deducted out of participant accounts. The big difference here is that from an optics standpoint, all participants see is the stated expense ratio, and they see the direct fee out of their accounts. They don't see a breakup of the difference with how much the fund company is keeping and how much of that expense ratio is going to pay for plan cost. So it is hidden from the participant. Your 408B2 disclosure we mentioned before should have a breakout of how much of the fund expense ratio is going to pay for the fund company, how much is going to pay for qualified plan services like your record keeping and administration cost, like advisory fees. So that's really how fees can be structured. Now we're talking about what should you actually be benchmarking. What are the different services being offered to your plan? The first is the investments, right? So this is what the fund company is actually charging to manage the fund, right? So you'll have active funds that are more expensive because you're paying a professional manager a premium to try to outperform the benchmark, where you'll have passive funds or index funds which are lower cost because all that manager is trying to do is just replicate the benchmark. So investment fees are always paid by the plan participants and always a part of the stated expense ratio of the fund. Administrative and record-keeping fees can be paid for either by the participants, which is the norm, or they can be paid for by the plan sponsor. So the administration fees really are your record-keeping, your trustee, your compliance, your testing, communications, right? This is the main thing we're isolating today in this analysis is how to live bid benchmark your providers for these services. The last component of fees that you could potentially be paying are advisory fees. So this is the paid to somebody like us, like NFP, like your broker, like your fiduciary advisor. And again, you have the flexibility to pay for these fees either as a plan sponsor, you can write a check, or your participants can pay them. And again, these can be paid through the revenue sharing in the funds, through direct fee out of plan assets, through forfeitures, or you can write a check. But as far as benchmarking goes, you're really tasked with ensuring the reasonableness of each one of these different fees. So each of them will be their own benchmarking process, right? What we'll talk about today is how to benchmark the administrative fees for the provider. In order to benchmark advisory fees, you'd go through something similar as we're addressing today, a live bid benchmarking process to see what services are your advisor delivering, and potentially get bids from other advisors for similar services. So again, benchmark each one of these three services independently. Now there's a concept of share class that's important to our discussion. So share class is basically for the same investment. So I'll use an example, the PIMCO Total Return Fund. That's it used to be the biggest mutual fund in the world. It's the exact same fund, but it might have different share classes, meaning it's the same investment management fees, it's the same investment management style, it's buying the same securities, it's doing the same trades. The only difference is you might have different fees, what you can pay for that fund. And there might be certain minimums to get a lower cost share class or stated fee for that fund. So an example is if you have an R4 share class for a fund in your plan, right? This is going to have both investment management fees baked into it as well as revenue sharing that we identified before. And in this example, this revenue sharing might be enough in your R4 share class to pay for administrative fees that the plan is receiving as well as plan consulting fees. Now for the same fund, if you drop down to its next share class, its R5 share class, it's going to have the same investment management fee usually, but a lower revenue sharing baked into it. So the revenue sharing might generate now just enough to pay for the administration fees that's baked into the expense ratio, and it's not going to have enough to pay for plan consulting fees. So you either have to write a check for those or have them be deducted out of participant accounts. And then the last share class for this might be called the R6 share class or the institutional share class or the zero revenue sharing share class. With these types of fund expenses, the stated expense ratio, 100% of it is going towards the investment management fee. So just the fund company is keeping it. There's no revenue to offset your administrative fees or plan consulting fees. So these would be a direct charge out of plan assets, or these would be something you could write a check for as an employer. So we're going to apply these to some case studies to show you really some different examples of how to benchmark for different organizations. And this should help add some clarity to the concepts that we've just discussed. So in this example, it's a healthcare company with 1,000 participants and about $41 million in the plan. We're going through a process to help identify the direct and indirect revenue sources that the provider is receiving, to quantify that data and to compare it to what other providers would quote on this plan. Our objectives out of this are to understand where and how the provider receives compensation and determine if the overall plan fees are reasonable. So here's our example. We're going to have a snapshot of the lineup here where we have a large cap value fund where there's $2 million in assets invested in it. Its stated expense ratio is 0.92%. So all participant sees is 0.92%. What we'll see in the plan sponsor statement now is saying, we know that this 0.92% times the $2 million invested in the fund is going to generate $19,000 of total cost that this large cap value fund is generating. What this information here, the revenue sharing to the right, is saying of this $19,000 of cost, 10,000 of it is actually revenue sharing that's going to go to be paid for their plan provider. Let's say a Fidelity, right? So for record keeping and administration. The difference between the $19,000 and the $10,000, so about this $9,000, is going to be kept by the large cap value fund here. All right, so that's how you break out those fees, right? 19,000 total is being generated, 10,000 of it is going to pay for your provider, and the difference is being kept by the fund company. Same thing with international stock now. This one has a different stated expense ratio of 71 basis points, generating $15,000 in cost based on how many assets were invested in it. Of that 15,000, 6,000 is going to the provider, and the difference, about 9,000, is being kept by the international stock fund. So we do this with our analysis for each fund, and we get kind of a weighted plan average, right, down here. So across all the investments, we know the weighted average expense ratio of all the lineup, what it might look like, let's say 15 about funds, will be about 75 basis points. A basis point is basically 0.01% is 1 basis point. So if I say 75 basis points, it's 0.75%. So the weighted average is 75 basis points, generating about $313,000 of cost across the whole plan. Of this $313,000, $132,000 of it is going to pay for the provider cost. The difference is what the actual fund companies across the lineup generate. What the provider is saying here is we're generating enough in this $132,000 to pay for our services of record keeping and administration. We don't need to add any direct fees on top of it that you see here would be any asset charges or build fees on top of what we see the plan level fees down here. So when we benchmark it, what we really care about is benchmarking this $132,000 right here. We want to see, is this what we're paying this $132,000 for the provider services, is that fair and reasonable based on what the market would price our plan at? So the next step would be to say, okay, let's take our plan fact set and let's share it with other providers, right? Let's give them the plan document. Let's give them our financials, how many assets, how many dollars are invested in each investment strategy. Let's give them the lineup that we're using so they can quote it, right? And when you get it back, we're now going to be able to look at a comparison. So when you isolate that $132,000 that the provider's keeping, you also want to look at the bids you receive from the bidding providers to say, well, our provider's charging $132,000. Everybody else is charging somewhere between $72,000 and $93,000. Our provider really should be right in the range right here between these bidding providers. So now you can take these numbers, right, and you can now take these numbers and bring them back to your provider, because these are live bids, right? You could move to these providers tomorrow if you wanted to, and nothing gets your incumbent provider to drop their fees like their competition coming in at a lower cost for the same, again, the same fact set, same services. So now you can negotiate with them and generate around $50,000 or so in cost savings in this example, right? So that shows you why it's important to isolate who is keeping what from a plan cost perspective, not just focusing on the total plan cost numbers. The second example will exemplify that case even more. So in this example, this is a smaller plan. It's a professional services firm, about 200 participants and $11 million in assets. Again, we're going to go through the same process with the same objectives. In this case, this plan sponsor believes in all index funds. So they're really just the stated expense ratio is going 100% to this index manager. These index funds do not have any revenue sharing baked in to pay for plan services. Because of that, we go ahead and we see that the asset charge is 82 basis points. So this is 82 basis points, or 0.82% being deducted out of participant accounts, generating about $97,000 in qualified plan cost. So when we look at the plan as a whole, we see the total cost, the asset charge plus the investment expenses here that the fund companies are keeping are 97 basis points, or $115,000 in cost. So when we go and we get live bids from the market, if we were to just look at total cost, right, that might be a dangerous effect, because when the total cost comes back, we're seeing in this example, there's $115,000 we're paying in cost, and the bidders came in at between $107,000 and $117,000, right? So we're right in the range. We're right where we want to be from a total cost perspective. But when we peel back the onion and show, well, what if we, look at just what are the investment companies keeping? Well, we see because this plan sponsors only in index funds, their lineups that they quoted, that they currently are managing are way lower cost for just the investment cost than the bidders showed. And what we showed what the bidders came in at just for record-keeping services, right? What we're really trying to get after are the services we're paying for fair and reasonable. We see that that $97,000 the provider was keeping was way above what the market priced their plan at, which was somewhere between $28,000 and $34,000. So because we took the extra step and looked at more than total cost, and we isolated how much of that total cost was going to the provider, we generated another $60,000 in cost savings. Again, the importance here is isolating the plan cost components, not just looking at total cost in as a bucket. So on an advanced level, we talked about some factors that impact pricing here. So we have our plan financials, fund considerations that we talked about, plan complexity, educational support, service requirements, and compliance testing. Now, those are some areas that providers are quoting based off of, but providers can receive sources of revenue from multiple areas. So this is where the advanced part of the benchmarking comes in, right? What we talked about was everybody's pretty standard, pretty similar, but we know providers can get revenue from what they've quoted their fee at, right? We looked at different fee comparison quotes before, but they can also get it from corporate services. So these are things like offering HSA administration to your benefit solution. This is like offering their own payroll services. This is maybe offering banking and lending services, right? A lot of banks out there have providery services. And the big thing you have to be careful of is if you're receiving additional services that benefit you as a company, don't necessarily benefit your employees from a 401k perspective, then it is not a qualified plan service, and you cannot use your plan assets to pay for these services. You must make sure if you're even getting a discount, let's say on your payroll services, or you're getting a discount on your lending, that's a big prohibited transaction because you're using the fees you're generating from the 401k plan to get you a better deal for corporate services. So make sure the plan does not help you get lower corporate service rates. Corporate service rates, on the other hand, if you're paying full price for corporate services and getting a discount on the plan rates, that is considered acceptable. Because again, that's your employer's cost, that's not your participant's cost. So something very important to keep in mind. Proprietary funds are the other, I'd say, the most prevalent source of additional revenue providers can generate, right? So they'll give you your stated fee as well as they'll generate fees from the funds that they also manage. This is an example we'll follow right after this where we'll show how to identify and quantify how much they're actually making with the proprietary funds. They might also have a brokerage account. So providers might have their own brokerage account and charge brokerage account fees. So this would be a separate account for participants to be able to go into and buy individual securities. There are some liabilities you need to be careful of if you offer a brokerage account, right? You don't necessarily have the ability to monitor all the investments in there. But just knowing if a lot of participants are using this brokerage account, providers might be generating additional per participant type revenue, or even revenue within that brokerage account from their own funds that are offered in the account. IRAs are another big area of revenue for providers. Some of the biggest providers in our industry generate actually a majority of their revenue from individual retirement account rollovers. So when you have a participant that retires and wants to take their money out, providers might have their own IRA solution that they're looking to capture those terminated assets into to make more revenue. So be wary, this can be conflicted. Your participants can be used as marketing, but also just understand this is another area your providers might be using when determining how profitable is your plan actually for them. And then managed accounts. So this is an additional service usually offered to participants that elect to choose it, where the participant gives discretion to a managed account fiduciary within it to choose their investments for them. Some providers use an outside party for this, which might be paying them revenue back based on what they generate through the fees for this additional service. Others have their own managed account services as well that they generate revenue from as well. So, the key thing to keep in mind here is when you're looking at, well, what are the providers actually quoting us, it's not just the stated fee. They could be getting revenue from all these other areas that might be, frankly, what they're actually looking for and less transparent to you as a plan sponsor. So definitely important to keep in mind. So let's do a quick case study on how to identify specifically that proprietary fund revenue, which is the most common event where providers do this. So in this case study, we have a retailer that's 16,000 participants, about $384 million in the plan. Now the record keeper, the provider they're working with, manages also 88% of the plan's assets in their own proprietary investments. So our process is going to help us do the same thing as before, identify direct and indirect revenue sources. We also want to then add this step of quantifying the investment revenue the provider is keeping and quantify the data and compare. We're then going to go through the rest of our process, get live bids, but we want to determine how the record-keeping fees are impacted when two sources of revenue are received, right? When they're receiving both their stated required revenue and they're receiving proprietary fund revenue. So we look at the example here. We have now the proprietary fund company is going to be called ABC Fund Company. This is the same company as the person who's managing the plan as a provider. So it's the same thing, right? We'll have $32 million in here. We multiply that times the expense ratio to get the total dollar cost that is generated, and we're seeing $80,000 of this $218,000 is going to pay for the record keeping and administration services. The difference between those two numbers, so about the $150,000 or so, is being kept by the same company, but on the investment side of the house. So again, they're receiving this revenue, and they're receiving the difference in that revenue. And the same thing goes through the whole lineup. So when we look at it, there's no additional direct fees in this example. Everything that's generated is through the stated expense ratio. And so we see that, as far as the whole plan goes, there's an average weighted expense ratio of 75 basis points, generating about $2.8 million in cost. We're seeing that of that investment management fee, 47 basis points of it is being kept by the current provider, and they're also receiving this revenue sharing amount that's going to pay for their record keeping and administration services. So you can see the double buckets of money now, not just the revenue sharing, they're also generating revenue from this bucket of money. So if we were to just do our same process and not allow providers to quote on the same fact set, including the ability to manage their own funds, we might come up with an issue. So we'll show you what that issue looks like right now. So we see we're just looking at the revenue sharing that was generated, right, just to pay for the record-keeping services and administration services. This does not include anything about the revenue they generated from their own funds. So we got providers to quote, again, not quoting on assuming they get to manage their funds, just what would you do if you're able to record-keep and administer the same plan with the same basic plan financials. And we see they came in at $672,000, which is lower than the incumbent. So still some cost savings, right, of about, pretty substantial, about $200,000 for this plan they could potentially save, or $100,000. Now, if we took those same providers and we said, well, give us a quote, not just to record keep and administer this plan, but now give us a quote, assuming you also got to manage 88% of the assets in your own funds. We now see the competitive average, instead of being about $100,000 less, is about $300,000 less, because bidder 1 and bidder 2 are now saying if we also got to manage our own funds, we would only need to charge $403,000 or $422,000. Before, bidder 1 and 2 needed $691,000 to do that, right? So they just gave a large concession on their stated fee because they know they would be able to generate revenue from a second source, which is their own funds. So this is the true apples-to-apples comparison because each one of these providers are getting to quote on record keeping the actual plan as well as managing 88% of the assets in their own funds, which now creates, instead of about $100,000 of savings, it's about $300,000 of cost savings. So when we talk about how to quantify, what was, how much revenue they were making, it was about $200,000 extra we're seeing here is the assumption that the providers are using if they actually get to manage about 88% of their own funds. So the key takeaway here is don't just have providers quote on the same fact set from your plan financials perspective, also allow them to quote on the same assumed ability to manage the same amount of investments as your incumbent provider, and you'll generate the best results for your participants in the negotiation process. So when we talk about how to pay for fees, this is the other big area. So what we just addressed was determining reasonableness of fees, right? So the key to that is you can compare your plan fees to averages, or you can compare it to live bids. Live bids generate results because you have live actionable steps to take back to your incumbent to get a lower fee, and it's going to be a specific target on your unique plan fact set. Now, how you choose to pay for those fees is not necessarily a fiduciary decision. Determining if the fees are fair and reasonable is a fiduciary decision, and a very important one at that, so you avoid the lawsuits and things we discussed at the beginning. But how to pay for fees, you have some flexibility. This is what we call a settlor function or a business decision, meaning you're not required to really pay for fees, but the DOL has urged you to at least go through a process to ensure how you're paying for fees is fair and reasonable. So what we mean by that is just how the 401k industry has evolved is we talked about that concept of revenue sharing. So revenue sharing is the portion of the expense ratio that's going to pay for cost. And so we'll use this example where there's $50 million in a plan across 5 investments, and some investments have more revenue sharing than others baked into their cost. So we see Fund V has 30 basis points of revenue sharing to pay for record keeping and administration services. Fund W has 25, and you see all the examples here. So the way that works is we have $10 million invested in each investment, and we multiply that by the stated expense ratio to get the total cost in each investment. Now when we look at the next step, we see of that total cost, here's the revenue sharing. So of the $80,000 in cost, we see that $30,000 of it is going to revenue sharing. Now, the challenge here is one participant might like Fund V and put all their $10 million in it, and another participant might like Fund Z just because that's what they want from an investment strategy standpoint. But now participant V is paying for $30,000 of expense, where participant Z is only paying $10,000 of expense, right? Just because there's different revenue sharing baked into the investments that they're choosing. The challenge there is both participants are getting the same services. They're receiving the same website to log into, the same statements, the same advice if they're getting education from their provider, right? So this isn't necessarily equitable because we see all the providers saying they need is the provider saying we need 20 basis points or 100,000, and it's being paid through different amounts of revenue sharing baked into the investment expenses here. So this is what we'd call variable revenue sharing or unlevel comp, where you're generating enough through the revenue sharing in the funds to pay for that full $100,000 that the provider needs, but you have some participants paying more than others to get there. So we see when we look at your allocation of cost, we see participants are bearing the full breadth of it through the stated expense ratio, and it's being paid, the costs are being paid through by the revenue sharing. So not necessarily optimal since you have some participants paying more than others. So the industry responded by some providers doing what's called a level revenue sharing model to pay for fees. So in this model, you still have revenue sharing covering your cost, but now each of your funds might have a share class that has the exact same amount of revenue sharing in it. So it's 20 basis points of revenue sharing regardless of what funds you choose. So now we see participant A and participant E are going to be paying the same $20,000 if they have $10 million invested into this fund. It's still getting us to a $100,000 number, but now everybody's paying the same amount in revenue for the same services. It's still, we're looking at the same 100% participant cost paid by the expense ratio in the funds, and we're still getting the same total plan cost. But now it's level because the amount of revenue sharing in the funds is the same. The challenge we have with this model is that not all share classes have the exact same amount of revenue sharing. Oftentimes you might be with a provider that can levelize this revenue so they can debit and credit, where no matter what, they have a technology system where they might add revenue or take away revenue from a certain investment because it's baked into what we call a group annuity account. So in those group annuity plans, you might have levelized revenue, but as far as most plans are on what we call an NAV mutual fund platform, meaning you just choose mutual funds out there, and not all mutual funds have the same amount of revenue sharing baked in. So getting to this level state is nearly impossible unless you're with some sort of provider platform that has the technology or is using a group annuity contract to go ahead and do so. So the next step the industry has taken to further levelize this revenue is this concept of no revenue sharing. So a lot of funds came out with saying, you know what, let's just say our stated expense ratio, 100% of it is just going to go to the fund company, and there's going to be zero revenue sharing baked in to pay for plan expenses. We saw a lot of index companies doing this first, but now most companies out there are offering some sort of zero revenue sharing share class. So now the participants' weighted expense ratio of all the funds is about 30 basis points. And so the amount paid by participants for administration fees are 10 basis points. They'll see that as a deduction out of their account. And the amount paid for by participants through an asset charge for advisory fees is another 10 basis points. Again, they'll see that as a statement on their account, but now they're going to see a much lower stated expense ratio. So when you go from our first example where everything was paid through the revenue sharing in the funds, through now being paid for through direct fees, it's going to be a lot more visible to the participants. So while it's great that everybody's paying the same amount, they're paying the same 10 for each, regardless of where they're invested, they're now going to see it for the first time. So if you do move from a variable revenue sharing lineup to something more transparent like a zero revenue sharing or no revenue sharing lineup, you might want to have some sort of communication campaign explaining that this was in their best interest. You might have lowered the plan cost through this exercise as well. Explain that it's more equal across everybody. They've always been paying plan fees, but now it's just going to be visible, and you believe in transparency as an employer. This by no means is required for you to go from the variable revenue sharing to the no revenue sharing, or even having level revenue sharing to no revenue sharing. But it is something where it is the trend in the market right now. A lot of employers are choosing to be more transparent with their fees and just more fair with them in general. But again, understand that there is a communication challenge that comes with it. The last way to do this, because the other challenge we have with no revenue sharing is that while most fund companies are coming out with zero revenue sharing share classes, not all of them are. Some of them might hold on to having some revenue sharing baked in, so you might not get your favorite managers at zero revenue sharing. So what providers have done is a fee levelization approach on that mutual fund platform, meaning we look at our first example, right, the exact same fact set as the variable revenue sharing. So we have basically we have 30 basis points in this first fund that has an expense ratio of 80 basis points total. So 50 is going to the fund company, 30 is going to pay for provider cost. So what the provider actually ends up doing is they end up taking this, here we go, sorry about that, struggling with my controls here. They end up taking this 30 basis points and saying, let's give it back to the participant that paid it. So the participant pays in 80, and then they get back 30, and now they're left with only paying 50 net. And then at the end of it, the plan is saying, okay, great, we've generated no revenue sharing because we've given it back to all the participants in the plan. So now we're going to just charge them each 20 basis points equally here to the right. So again, this participant in Fund V is going to be paying for 30 basis, they're paying 80 in, they get 30 back. So they're net paying 50, and then they're going to get charged an additional 20. So they're paying net 0.7% or 70 basis points. But each participant is going to be paying the exact same amount regardless of invested, because all that revenue sharing baked into the fund they chose to invest in is going to be given back to them, and then they're going to get a level fee on top of that that they're going to be charged equally. So this is a very equal way to do it, but it is, again, comes with a communication challenge, because now participants are going to be seeing on their statement 80 in, 30 back, and then taking away another 20. So it requires some sort of education and level of communication with your employees, even though it is the most fair way to go about it. So that's how you can structure fees. And the important thing to know is when you're structuring fees is while we've used the very simplified assumption when you change a share class that the investment management fee baked into the expense ratio always stays the same, that's not always the case. There are definitely cases out there where your lowest cost share class, so the one without any revenue sharing, might not be the best. So what we're seeing out there is basically, if we look at this example to the bottom, ABC Fund Income is in the fund name there, and we see that's the same fund with the 3 rows below it, so Fund Income T and Fund Income T6. Those are the different share classes that you might have with this fund. And so if we had $100,000 invested into this fund, we would see the first fund has a 47 basis point or 0.47% expense ratio with some record-keeping revenue sharing baked into it. It has the 25 plus the 10 baked into it, where the net investor expense, so what they end up paying for the actual ABC Fund Income Company's cost for the fund company, is 12. So we see that 12 right here is what they end up paying, right there. If they were to go to the next lowest share class, which is this 42 basis points right here, they're going to pay lower in, right? So it's 42 in, but now there's only 20 basis points of revenue sharing to pay for plan costs baked in, so they're paying net 22 to the same fund company. Even though it's a lower stated expense ratio at the onset, less of it, they were actually getting charged less for the actual management of the fund before. They're now getting charged for the same fund management services now because there's just less revenue sharing baked in. And then on the T6, it exacerbates that issue even more, where 37 is the lowest stated expense ratio here, and there's no revenue sharing baked in, so they're paying 37 basis points to that fund company for the exact same fund and fund management style. And the difference in that you can see here. You know, for $100,000, that's a $100 difference here, or a $250 difference. And what providers will often do is they'll come in and they'll try to sell you saying, hey, let's drop the expense ratios, right? Let's drop the share class from 47, let's drop it down to 37. Well, what that provider just did was they just put $250 back in their pocket per $100,000 invested in this strategy. So while it might look lower at the onset, it actually increases the amount they're collecting for the investment management strategy, because now you have nothing in here to pay for plan costs. That's just going to be a deduction out of participant accounts or something you'll get a check for. So again, be careful. Don't always just choose the lowest cost share class here, because you want to look at the most efficient net investor expense. You want to look at what is net. So if you take the expense ratio minus the total revenue sharing, that is left with what the investment management fee is for that fund company. So you want to look at the lowest net investor expense, because not always will the lowest cost share class be the right fit. So to maximize your negotiation leverage, we've talked about this, but a nice summary is really when you go through it, when you go through this process and you respect the provider community by giving them the ability to have a fair chance at quoting in an apples-to-apples comparison, they're going to give you the best quote. So you want to make sure your process is fair, that you're potentially working with somebody who's experienced in doing this on your behalf, that knows where a lot of those additional revenue sources are coming from, and also working through somebody who might be respected by the provider community. Because oftentimes if you're just getting provider quotes just to give you pricing leverage, they won't want to participate. So if it's somebody who does a lot of these as the community, and the providers know, well, we might give you 6 quotes as just a pricing exercise, but the next one might be because a plan is actually considering to change and consider our services, they'll be more willing to put their best foot forward, even when you're going through this process. That's just a pricing exercise. The other way to maximize negotiation leverage, as we talked about in the third example, is to make sure you get a like-to-like investment lineup. So you get the current lineup and you get a lineup with comparable investment revenue, right? So if your incumbent provider is managing a lot of the assets, you want to give the bidding providers the opportunity to do the same, so you maximize that leverage. And then, third-party negotiations often improve results as well. So if you look at provider tactics that a third party can help you swim through, set realistic expectations on what the cost might be coming out of this with no emotional connections, right? You really get the enhanced provider negotiation. Oftentimes we'll see a client that has been with a provider for 25 years, they've known their RM forever, but they might be getting raked over the coals from a pricing perspective. It's important to remove that emotional connection because you as fiduciaries have the responsibility to ensure you're always doing what's in your participants' best interest. So removing that emotional connection is something we've learned over the years. Can be a challenge, but it's important for you all to be prudent fiduciaries through the process. So takeaways, again, how to benchmark. We can look for averages in the between years, but doing live bid benchmarkings about once every 3 to 5 years. We looked at some factors that impact pricing, your plan financials, the services, the investments, as well as we identified some additional sources of revenue providers can get through additional services they might be offering to your plan that might impact their pricing they're offering to you. And then to maximize negotiation leverage, right, make sure the process is fair and that you're truly getting an apples-to-apples comparison to generate the best results. So with that, I want to thank everybody for their participation today. I actually didn't see any questions come through, so hopefully everything was landing well. But if you like a copy of this presentation to take back to your committees, please feel free to email me at cameron.jones@nfp.com, and we'd be happy to send it over.
All right, thanks so much, Cameron. Awesome information, great webinar. We'll just go ahead and close it up and hope everyone has a great afternoon, and look for that email tomorrow with links to the recording and all the continuing education credit information. And of course, join us next year at one of our mid-size retirement and healthcare plan management conferences where you can meet Cameron in person and hear more about what NFP can provide as far as services. Thanks again, Cameron. Great job. Have a great afternoon.